Circle to the 18th of September. If the Fed blinks and cuts, Bitcoin doesn't grind higher, it reprices. Scarcity meets fresh liquidity, and the lane to 200,000 opens fast. Here's the play. Rate cuts compress real yields, and capital hunts for scarce, high-performing assets. And the assets with the structural supply caps get bid first. And the hardest is Bitcoin's home field. Today, I'll map exactly why a post-cut world is a different regime for BTC, and how the mechanics funnel demand into a fixed supply, and what should actually get us to 200,000 Bitcoin. It's the risks and the tripwires that would prove us wrong. The regime shift. Let's get crystal clear. A Fed cut isn't about basic points. It's a signal. It says growth wobble, inflation worry, markets translate. That is an easier financial conditions ahead. Second order effect. Real yields drift lower and the opportunity costs of holding non-yield scarce asset like Bitcoin collapses. In that environment, investors don't just buy risk, they rotate from cash and short duration into things with convexity assets that respond disproportionately to liquidity. Bitcoin is that convexity. Let's talk mechanics, not magic. Bitcoin's issuance is problematic. Post-halving, the network prints roughly 450 BTC per day. That's it. Meanwhile, the demand side is no longer a weekend hobby. It's bought through spot ETFs and mandates. When persistent buy programs meet, prices don't itch, they jump. Think of it like this. You've got a tiny tap filling a bucket while someone else is installing a bigger drain each week. The water level doesn't rise linearly. It reprices marginal buyers and sellers meet under the new liquidity assumptions. Okay, but why 200,000? At 200,000, Bitcoin's market cap sits around 4 trillion. That's still small next to global gold, equities and bond markets. A modest reallocation, a few hundred basis points out of cash and bonds as real yields roll over, creates a non-linear price response in an asset where daily net new supply is microscopic. If ETFs and direct buyers soak up just a few $1 billion of incremental weekly demand in a post-cut liquidity regime, free float tightens. You don't need every investor to move, just enough marginal capital to squeeze a thin spot into the order book. Here's what's changed compared to previous cycles. Before, retailers chased, now institutions allocate. Spot ETFs convert "I like Bitcoin" into automatic flows. Post-cut investment committees can justify upping risk, cheaper capital, easing conditions, improving liquidity. The gate that kept maybe later money on the sidelines unlocked. Meanwhile, minor dramatics post-halving matter. With block rewards halved, miners sell fewer coins to cover costs. Structural sell pressure removed. Less new supply plus sticky ETF demand equals squeeze potential. This isn't just a meme, it's a spreadsheet. Let's talk plumbing beyond the policy rate and broader M2 trends. When the Fed is easing and money markets rates glides down, cash can leak out of the RRP and cash-like instruments into risk assets. Some of that spillover finds the highest assets with credible scarcity. You know the ticker. You don't need a tidal wave, just a consistent trickle that overwhelms a thin supply. Rate cuts mean real yields drift lower, opportunity costs of Bitcoin falls. ETFs keeps buying set and forget allocations, hoovering coins. Miners sell less, holders sell higher, free float tightens. That chain is how you go from uptrend to repricing. Before we talk about the path, not just the target, if you haven't already, drop us a like and subscribe with notifications for more content like this. Also drop us a comment below. Do you hold Bitcoin? And what's your price prediction by the end of the year? Let's sketch out a credible path, not fantasy candles. Phase 1, post-cut repricing. BTC clears prior highs with volume and volatility expands. Phase 2, consolidation. With higher lows, ETFs net positive and dip buyers rewarded. Phase 3, narrative flywheel. Media coverage and PM letters legitimize a higher allocation band. Phase 4, extension. As upside volatility returns, pushing towards levels 120k, 150k, 180k, and then 200k. At each shelf, supply shows up, but at each time it gets absorbed faster because the buyer's base widens. Let's talk rough numbers. Daily net new supply post-halving 450 BTC. At 100k, that's 45 million per day of minor issuance to absorb. ETFs alone can do multiples of that. New layer indirect purchases, corporate treasury nibbling, and quantum momentum. You don't need crazy inflows, just a steady imbalance. That's the quiet math behind the loud chart. What if the Fed doesn't cut? Then it's delayed, not dead. BTC has shown it can climb in restrictive regimes, but repricing windows open widest on easing signals. Isn't 200,000 just hopium? It's an output of flows versus supply. Real yields stay high and flows fade. We don't get there. Simple. This is not financial advice, but here's a framework professional use. Define your time horizon. Are you trading a 3-month liquidity impulse or holding a multi-year scarcity story? Stagger entries. If you believe in repricing, you pre-plan. Add on volatility, not after headline. BTC will move 2 to 5% in quiet session. More on news. Don't size a position that you can move your whole month in a day. Milestones on the road to 200k. 100k century mark. Expect headlines and initial profit taking. 120 to 125,000. Many models mandate start considering overweight. 150k. Media narrative flips from bubble to allocation case. 180k to 200k extension phase, where trend systems, momentum funds, and late allocations compile in. Between these shelves, pullbacks of 15 to 25% are normal, healthy even. They reset leverage and reload the move. The narrative flywheel. Price makes news, news makes buyers. Once BTC clears highs, post cuts with volume, the narrative flywheel accelerates. See pivot, price breakout, coverage and PM letters, model portfolio ads, and further price strength. That's how a market reprices, not in a straight line, but in a series of higher shelves. Bottom line, if the Fed cuts after 18th of September, the fuse is lit. Scarcity plus liquidity plus institutional rails create a repricing window. Call that terminal number what you want. My map says the lane to 200,000 is open. Don't confuse volatility with risk or yield with safety. Have your plan before the cut, not after. And as always, financial advice, act accordingly. Let me know in the comment section below, do you believe we'll smash through 200,000 this year or higher? Also, don't forget to like and subscribe with notifications to make sure you don't miss any future Bitcoin video. You definitely don't want to miss my next one. It's a banger. Thank you all for watching, and until next time, peace!